All right, I'm going to get started. Hello, everyone, and welcome to today's TMA webinar. My name is Paul Kueber, and I am Managing Partner at Maybury Partners, where we focus on turnaround and restructuring in small and mid-market companies in operational improvement, turnarounds, and lender assistance. It is my pleasure to moderate today's webinar on restructuring in a cryptocurrency world. We recognize this is a topic of great interest. We want this to be an interactive session, so feel free to submit questions in the chat, and we will get to as many as we can. I would like to introduce today's panelists. First, Ryan Gross. Ryan is a director at Getzler, Henrich, specializing in providing turnaround and restructuring support services to distressed and underperforming companies and municipalities, as well as advising boards, management, and creditors. Ryan has served as interim CFO, controller, treasurer, and advisor for clients in the automotive, manufacturing, retail, and financial services, and has provided restructuring and turnaround services in various capacities. Next, Ron Spinner. Ron is a principal at Miller, Canfield, Paddock & Stone PLC's Bankruptcy, Restructuring, and Insolvency Practice Group. Before becoming an attorney, Ron had careers in both information systems and marketing analytics. This experience gives him a unique perspective, which he leverages to develop results-oriented solutions for his clients. It also has helped him better understand the underpinnings of cryptocurrency and guides his thinking when considering the legal issues associated with them. Ron specializes in bankruptcy litigation, including preference and fraudulent transfer defense. Ron is currently developing an article on how to handle cryptocurrency in bankruptcy cases for a leading legal journal. And finally, Nick Ward. Nick is a senior manager at Armanino's blockchain practice with more than 6 years of experience performing compliance-related work over digital asset and blockchain companies. Nick leads financial statement audits of public and private companies in the industry, including Bitcoin mining operations, first and second layer distributed ledger applications, and cryptocurrency exchanges. Nick assists clients with the complex tax and accounting issues that arise when dealing with Bitcoin or other digital assets. Nick's passion lies in teaching professionals and business owners about Bitcoin, digital assets, and other blockchain technologies. Next, I would like to thank our sponsors. Please remember that many of these events would not be possible without the support from our sponsors. So please keep them in mind when your next need arises. And just a quick advertisement of our upcoming events. October 26th is Cocktails and Conversation at Valentine Vodka. November 16th is Senior Living Industry in Distress, how the recent Henry Ford Village turnaround highlights challenges in the sector. And finally, November 30th is our annual holiday party at D'Amato's in Royal Oak. All of these are sure to be great events, and I hope to see you there. Now let's get started. First, I'll review the agenda. Ryan will first give an overview of crypto, trying to define a lot of the terms that maybe you've heard around the crypto space. Crypto is more than just a trading vehicle or an investment. Then Nick will dig deeper into corporations, how they might use crypto, and how you might see crypto in balance sheets, as well as some of the issues. And next, Ron will review legal questions and ramifications around crypto. And finally, just in case you might be feeling a little overwhelmed, we will provide a little entertainment with a mock scenario of crypto, showing you how you might see crypto in a company, and then what your responses or next steps might be. Again, please keep the questions coming. We hope to carve out time at the end to go through some questions that have already come in. So let's get started. And with that, Ryan, please take it away.
Thank you, Paul. So fintech, for those of you that have never heard of it, fintech is a new technology that seeks to improve and automate the delivery of financial services. The easiest way to think about that is by picking up your phone and looking at the mobile apps, the investment apps, those type of things. As you can see, fintech covers a lot of sectors, but due to time constraints today, we're not able to get into all those. So we hope to discuss fintech in a later panel discussion. Now I'm going to talk about blockchain. What is blockchain? Many of you have probably heard of it, but don't really understand it. The easiest way to think about it is by its name, block and chain. Blocks are containers that hold records and transactions, and each new block added to that chain contains the information from the previous blocks. The chain makes the records permanent and unchangeable. What kind of things does blockchain make possible? Well, to name a few, digital ledgers, such as crypto transactions, which I'll talk about in a couple minutes, NFTs, peer-to-peer financial services, smart contracts, supply chain management, file sharing, data management, identity verification, and voting, just to name a few. Now I'm going to explain how blockchain and cryptocurrency go hand in hand. So blockchain provides the security. Each cryptocurrency has its own blockchain, which is separate from others. A blockchain is similar to a bank's balance sheet or ledger in that it's constantly re-verified. However, unlike a bank's ledger, a cryptocurrency is distributed across participants of the digital currency's entire network. No company, country, or third party is in control. Anyone can participate. Cryptocurrency is a digital money created from code. The cryptocurrency economy is monitored by peer-to-peer internet protocol. Cryptocurrency is an encrypted string of data or a hash encoded to signify one unit of currency. Many of you have probably heard of Bitcoin. It launched all the way back in 2008. It's the first cryptocurrency and by far the biggest and most well-known. Since 2008, cryptocurrencies have grown as a digital alternative to money issued traditionally by governments. Just to put that in perspective, today there are almost 21,000 different cryptocurrencies out there. The various types of cryptocurrency. So the most popular by market capitalization are Bitcoin, Ethereum, Bitcoin Cash, and Litecoin. Some other popular ones, as you can see here, are similar to Bitcoins. However, others may be based on different technologies or have different features or do more than just transfer value. But three important things to take away are online transfer. There's no middleman, bank, or payment processor. Transactions can occur essentially 24/7 anywhere in the globe. It's not controlled by the government. There's no central authority. Anyone can participate. And it's a peer-to-peer network, computers running free and open source. When thinking about cryptocurrency, there are 7 key concepts that you're going to want to really think about when you're diving into them, looking at different types of cryptocurrency and different things of that nature. The first one is transferability, which I think I may have hammered on already, or you're already aware of. But crypto makes transactions with people on the other side of the globe as seamless as paying your local grocer in cash. The next one, which I find important, is privacy. When paying in crypto, you don't need to provide unnecessary information, which I'm sure we've all had to experience, whether it was providing our email addresses, our phone numbers, our addresses, only to have that information sold to a third party, and then we get blasted with spam or text. When you use crypto transactions, you don't have to provide any of that information. Therefore, it's not sold to third parties and you're not at the risk of that. The other important thing is you're not providing your financial information, so you don't have the opportunity to be defrauded, for it to be defrauded. Security is another important item. Almost all cryptocurrencies, including Bitcoin, Ethereum, and Bitcoin Cash, are secured by technology, which I already discussed, called blockchain, which is constantly checked and verified using large amounts of processing and computers. And then we have portability. Because cryptocurrency holdings aren't tied to financial institutions or governments, you can use them anywhere, no matter where you are in the world. And also, no matter what happens, whether something happens to a global finance system or its intermediaries, you won't be impacted by that. Transparency. Many people wonder, how do I see what happens when I use cryptocurrency transactions? Well, Bitcoin, Ethereum, and Bitcoin Cash, their networks are public, which means and published. Every transaction that occurs on their network is published. This means that there's no room for manipulation of transactions, changing of the money supply mid-game, or adjusting things without people on that network being aware of it.
And Ryan, this is an important point that everything is published, right? But because you only have given up so much information, the stuff that is published is not damaging, generally speaking. I mean, it's only the actual transaction. It's not any of the financial information about the parties who actually engaged in it.
Yep, that's exactly right. And then we have irreversibility, which is very important. Cryptocurrency payments can't be reversed. And that's very important to merchants because it reduces their likelihood of being defrauded. And for consumers, it's beneficial because it has the opportunity to make commerce cheaper by reducing the need for credit card companies, which traditionally charge high fees due to the potential for returns. And lastly, safety. So the network powering Bitcoin has never been hacked. And the fundamental ideas behind cryptocurrencies that help make them safe are the systems are permissionless and the core software is open source, meaning countless computer scientists and cryptographers and IT specialists have the ability to examine it for security and improve it in real time for any flaws that may exist. And lastly, I'm going to talk about stablecoins. So stablecoins are one option for crypto curious investors, and they're unique in that they provide stability, hence crypto stablecoins. One of the most common ones is the USD coin. It provides all the attributes that crypto transactions do. In other words, it's seamless, it has the security of it, but it has one key feature, which is the pegged value. It's typically pegged to a fiat currency like the dollar or a commodity like gold. And this is important because it makes it so its valuation is less likely to shift drastically day to day. This stability can increase the everyday use as money because both buyers and merchants can be confident that the value of their transactions will remain relatively constant over a longer time frame. And with that, I'm going to hand it over to Nick.
Thanks, Ryan. And thanks again, everyone, for having me, especially Ron, Ryan, and Paul. It's been a pleasure kind of getting to know you guys and lead up to this event. And of course, TMA for having us. Truly a pleasure to be here. So I hope everyone's enjoying, having a good day. So my goal here is to just bring you some insights into kind of how corporations are currently using or have used crypto today. Some of that will be from personal client experience, and then other just kind of what we see in the industry as well as outside the industry. And then we'll dive into some other examples. But yeah, to kick off here. So at the start, right, the obvious one is kind of as a currency. Certainly the volatility of these currencies can cause people to be wary of using it. I'll talk a little bit more about that in a couple of slides, but generally there's services now, right, where there's a third party that if you wanted to accept crypto for payment, your customer could, pay their invoice with Bitcoin. The third party will process it on its way to you, convert it to cash. So you, the company, only receive USD. It's usually the fees about 1% or 1.5%, so cheaper than your credit card processing. So basically the point there is just to call out that, people are starting to use it from that angle, accepting it for services opens them up to new customers that maybe want, have crypto and want to spend it. And then also to Ryan's point, a slide or two ago on the irreversibility of transactions. And what that really means for merchants is the estimate is about each chargeback costs about $191. That's the estimated kind of cost for 2023 outlook. And with an estimated expected 615 million chargebacks, that's about $117 billion, give or take, in those fees for merchants, banks that are getting passed to consumers. So there is a big opportunity for savings on that front. We're also seeing clients and companies that have employees that want to get paid in crypto. So that's one avenue, or it's just easier for them. So, as we went through COVID in the remote world, I think COVID certainly excelled that process towards some of that and making people comfortable with it. And with that comes, you have potentially employees or contractors that are in completely different states than you operate, potentially international. And anyone that's tried to send a wire or tried to pay someone internationally knows, how difficult that can be through the current banking and SWIFT systems. And so sending crypto is a much simpler, quicker, less costly process. So we've seen people doing that. Nonprofits have found that this is a whole new avenue to solicit donations from. And the big advantage there is during a crypto bull market, so not so much right now, but when there are crypto bull markets, the donor can get the full fair market value at the time of donation as a charitable deduction, right? So there's some big incentives to solicit those donations. We've helped a number of nonprofit schools and entities on board and get set up to do that. And again, the other key thing to point out in accepting it for services and the nonprofits is generally, if you're not using that third-party processor, there's not really a cost to you to hold this stuff, right? Certainly the risk of the volatility, but if you have your own wallet, it's not like you have to pay a fee to have that wallet hosted or anything. So there's really a very low cost to just accepting and handling it. And then access to smart contracts. So we're just going to talk about this very briefly, high level, but part of crypto and these blockchain ecosystems allows for smart contracts to really flourish and kind of improve processing. So if you think of smart contract very simply as an if-then kind of function. So let's say, Ron and I want to place a bet on what the weather will be tomorrow. We build a smart contract to basically say, all right, we're going to bet, half a Bitcoin on what the weather will be. We each have to submit our bets, in temperature by this time on this date. And then on the date we're betting on, at midnight, it's going to go to weather.com and pull it. And depending on who won, it'll execute the contract itself.
And Nick, there's a point there is that we have to agree on what the actual determining factor is, because this is going to be automatic. And once you set it up, that's it. It's going to do whatever it's told, regardless of whether it still makes sense, right?
Absolutely. And if we're going to be betting with crypto, that there's no chasing that down other than Ron begging me to send it back, because
no backsies.
Yeah, exactly. And to the extent we were betting on something, or maybe we were using like a smart contract to execute payment on delivery of goods, so those goods are in the real world, we would need to figure out a way or how we would tell the smart contract that yes, the goods were delivered. And to be frank, right, as the supply chain continues to get digitized, even outside of blockchain, just with that AI smart tech, right, there is probably a likely future where, hey, there's a reader on the goods, and GPS satellites can just target, it'll know when it's at my location, and maybe all I need to do is check a quality box that like, hey, I actually got boxes with goods in it and they're not empty or something. So a lot of cool opportunity there. And typically those smart contracts are going to be involving crypto in terms of the payment to just make it completely seamless. The other end of the spectrum that some companies are doing is kind of treating it as a treasury for a couple things. So inflation hedge is one of the big ones. And so, obviously right now there's a lot of attention on that narrative for Bitcoin specifically. Is it an inflation hedge? As we've seen inflation continue to kind of rocket. Another CPI day today indicated it hasn't slowed down. Inflation or Bitcoin has not done well, right? It's in a definite downturn right now. Part of that really is because it's still a risk asset, right? So along with like tech stocks and other risk assets selling off just like the rest of it, people are going to get into cash and other hard assets. But over time, the question is long-term, it may continue to outpace it. And part of quickly high-level theory there of people that kind of are treating it this way is that Bitcoin itself, you've probably heard there's only going to be 21 million. So that issuance, so right now there's 900 new Bitcoin put into circulation or printed right a day. That issuance halves every 210,000 blocks, which comes out to about every 4 years. And it will continue to do so until that 21 million is issued. So people view it as an inflation hedge because they know what the inflation of Bitcoin itself will be. They know the timeline. We can estimate the year 2140 is when it will be done, and there will be no more inflation because they won't create more. And so the theory is that over long-term frame, that will continue to, rise in value against fiats like the US dollar. So time will tell, but that is a way people are using it now. The other is to earn yield. So there's been, a lot of new products and offerings in the space where you could, lend your Bitcoin to whether it's a creditor, a bank, or even some peer-to-peer networks are experimenting it. and earn a percentage of interest. Certainly doesn't come without risk. Ron's going to get into some current scenarios on, people that had crypto at Bitcoin or other digital assets or crypto, held on another platform, maybe trying to earn yield. Well, now that platform's gone bankrupt. What do you do? How do you get it back? Remember, irreversibility. And then debt instruments. We've seen people start to issue cash loans with crypto as collateral. We've even seen fully Bitcoin denominated loans. So the lender lends Bitcoin to the client customer. They pay the loan back in Bitcoin. They pay the interest in Bitcoin. And there's some funky accounting that has to go on there for your financial statements, because you have to basically create a derivative to track, the fair value of that against the actual loan principal balance, depending on, where the price of that Bitcoin was when you took out the loan and where it is today at times of payment. So a lot of interesting stuff. And the last point, education, R&D, is really, all those things I mentioned came about because people, of course, Bitcoin and crypto have their theories why they're coin or what's best about it. But until companies start using it and actually saying like, yeah, I did use this and I saved on chargebacks, or I was able to use a smart contract and, make the experience better for my customer. That's, how we find that out. So a lot of companies are still just learning and trying to identify what will be good use cases and go from there. So you can go ahead and go to the next slide. So here's just a quick kind of look at Bitcoin on the balance sheet. So in 2021, we started to see public companies actually buy Bitcoin and put on their balance sheet. Some of these certainly were people operating in the industry, so trading desks, exchanges. But what was interesting is some weren't, right? We saw MicroStrategy, one of the most famous, and then Tesla, of course, accepted Bitcoin for car payments and also put it on the balance sheet. We've also seen ETH to some extent get put on the balance sheet. Right now, that's mostly companies within the space, but it doesn't change that some of them are publicly traded, buying ETH, keeping it on their balance sheet. But of course, all this comes with, holding crypto is you're going to hold it through its volatility. So we are in a current, market downturn right now where the all-time high of 69,000 or about there was, I think last year now. And it's dropped about 70% in value. So trading around like 18 or 19,000 a coin. As you can see on the chart, just some other kind of pretty gnarly swings within a week or even a day. It certainly is, not for the faint of heart to watch. And it almost makes traditional equity markets, when you see like a lot of big news because a stock dropped 5 or 6% and there's all this turmoil, it's like, oh, that doesn't even seem that bad compared to the crypto space. So with that, let's talk about the financial statement impact that happens when you are carrying it. So you can go ahead and hit the next slide, Paul. So accounting and tax for crypto as it stands today, there is no authoritative GAAP guidance still today. So what that means is, we know cryptocurrency is not cash or a financial asset. For it to be treated that way from an accounting perspective really comes down to governments kind of making it legal tender. And so, that's yet to be seen. So what happens is it kind of defaults into what's the current framework where it fits best. There's certainly no, physical goods behind it. So that kind of puts us like software. I mean, it is essentially software. And so that puts us in that intangible asset life. And then it's indefinite live because really ultimately, for example, Bitcoin and most cryptos, if nobody did any development, they would still operate as they're operating today. So with that, how you account for those things means you treat it at its cost basis when you obtain it. So if you buy a Bitcoin for 10,000, you put it on the balance sheet for that. And then you don't do anything with it aside from test for impairment. So let's say it runs up to 20,000, it's going to be 10,000 on your books, but then it drops to 5,000 the next month. You would impair it for $5,000. So you'd run, an unrealized impairment loss or your earnings, take the balance sheet down. And then if it went back up, you don't do anything with it. You don't mark it back up. So as you can imagine with those previous volatility figures, it really makes a confusing statement for the reader. So with that, we're part of a digital chamber of commerce group, it's called. We participated a few months ago in letters to the Financial Accounting Standards Board, urging them to address this and get some authoritative guidance on crypto put forth. And we also recommended in that it should be carried at fair value, reflect the changes in earnings. So at the time they're reporting quarterly, annually, they mark it to fair value. and can kind of move on. It's a better reflection of their economics. We think it's more beneficial to the user. And the really great news and update, and this is pretty much breaking news because it dropped yesterday, FASB did unanimously vote for the fair value treatment. So that's awesome. All they've said so far is that they basically classified that the fair value at crypto assets they would have to meet these kind of definitions. So meet the definition of intangible, so lacks physical substance. So we check that box. It doesn't provide the asset holder with enforceable rights or claims to goods or services created and the token resides on a blockchain, secured through cryptography, and then are fungible. So fungibility simply means that, one Bitcoin is the same as every other Bitcoin, right? Just US dollars are fungible. My dollar, I give Ryan, if we trade dollars, they both do the same thing, retain their value. So that would mean most cryptocurrencies would fall under fair value treatment. Something that's interesting, NFTs, if you've seen that in the news, those are non-fungible tokens. They could be art, lots of different things that we're not getting into today, but those wouldn't fall under there. So there's still some interesting things to work out. And unfortunately, this is not able to be implemented yet. FASB still has to do final approval, and my understanding is it could take months to even years. So hopefully not that long, but we will see. But that is an exciting development, and definitely we are pleased, and I think most of the industry is pleased with the fair value treatment. I definitely felt nerdy last night when friends, clients, and colleagues were all texting, all excited about an accounting standards drop. And then from a tax perspective, the IRS put out a notice in 2014, which made they called them virtual currency. So all crypto and blockchain assets essentially are property in their eyes. So very simply, much like any other property, stocks, you track your cost basis when you receive it. And then if you spend it, so you buy goods or pay for services, or you sell it for US dollars or other fiats, you take the proceeds at that time compared to your cost basis, report the gain or loss. Short term, you're at ordinary rates, long term, you're at the different capital gains rate tiers. So that's currently how it is treated and still stands today. Go ahead and up to the next slide. And so start to give you some picture of like what this looks like on financials. So again, under that in current framework where we have to impair it, companies will have to establish a policy of how often and how they assess impairment. And then, likely for public companies, not likely, they will have to do it quarterly because they're going to have to report quarterly earnings. Private companies could really just do it annually when they're doing their annual statements for their audits. There's not a huge need to be tracking it in between other than their own records. But strong records are key. Up to this year, it was just a few months ago that one of the crypto accounting softwares, which there have been a few to kind of come to fruition, are getting built, was able to start tracking impairment, and it's still not perfect from the clients I have that are using it. So a lot of this was done in Excel, a lot of work for the accounting teams, a lot of work for the audit teams to unravel and kind of check, make sure they were doing things right. But as you can see below, and I described on the previous slide, like this is what it kind of looks like, where you bought it in November at 15, and in the middle of December, it dropped to 12. So at 12/31, you'd see an impairment on the balance sheet, or an impairment on your income statement, and the balance sheet dropped. You can go ahead and pop to the next slide. And I'll quickly do this one because you can definitely check it out yourself, and I want to be conscious of time. But Tesla, if you followed the news or didn't, Tesla bought, accepted Bitcoin for car payments. They put Bitcoin on the balance sheet, and then a few months later announced that they were no longer going to accept Bitcoin for the cars due to potential environmental concerns of the energy use of the network. And so they wanted to do more due diligence on there. They didn't sell the Bitcoin on the balance sheet at that time. They have liquidated some tranches since. I think they've done 2 or 3 sales, but they still have some. But essentially, that was at the same time as China kicking out Bitcoin miners, which caused a brief dip in the price in that May, I think it was like May or June of 21. And so Tesla, still today, if you go pull up their recent quarterly filings, I referenced Q2 here, but you'll see the impairment loss that they have sitting there on that Bitcoin that they bought at somewhere around like 40K, and then it dipped to 30, now 20, obviously. So you can check that out. Like I said, you'll see Bitcoin on the balance sheet, you'll see the unrealized impairment on the income statement, and then definitely encourage people to look at the cash flow statement. That's if I tell anyone, if you want to learn or understand financials, cash flow is always the best because it gives you that picture of really at its core, what's the company bringing in terms of cash versus spending, and is that a net positive or negative? And then you can see how they take that money from operations and either invest it or use it to continue to build their companies out in capital. So we can go ahead and jump to the next slide. So we wanted to kind of call out another real world example. So Ryan did a good job of kind of talking through stable coins. And as he alluded to, you traditionally, most stable coins, they're pegged to the US dollar. And to keep that pegging, they just have dollars in the bank to back the tokens on a blockchain. So if there's 10 blockchain tokens to represent a dollar, they've got $10 in the bank, ideally, to back that. But we have seen other stable coins attempt to be backed by baskets of other fiats, maybe commodities. Facebook very famously in 2019 put out that they were going to create their own coin. It was going to be backed by a mix of commodities and fiat assets. The head, David Marcus, got called before Congress, and then Mark Zuckerberg also got called to just be basically drilled on what this would do if it was a monopoly issue, all sorts of things and concerns they had. And also what would back it? If it wasn't all USD, does that undermine the USD? So really interesting how deep these discussions go into just outside of crypto and technology. But the point is that to keep a dollar peg with a basket of assets would be somewhat difficult, right? That's going to take a lot of consistent balancing, rebalancing. So one of the exciting projects in the last year in the space was called Lunaterra. So it was a stable coin that was going to be pegged to the dollar, but it was doing so. It called itself an algorithmic stable coin. So it had a coin called UST. That was what was meant to stay pegged to the dollar. There was also a coin called Terra Luna that basically, if you took $1 of Terra Luna, you could burn it, it's called, which means destroy or convert it to 1 UST. And you could do that vice versa. So if you're burning Luna, you're increasing UST. And then in the background, that's balanced to keep the peg, balanced to stay pegged to the UST to stay pegged to the dollar. They offered all these, there were a lot of like 20%, really high yield opportunities if you were loaning it, which in hindsight was probably a way to get more Luna or UST in their doors to help them balance. But that was what it was during the time. And then, based on the arbitrage between the two tokens, traders could find profit, right? Profit opportunities if they were trading it. And so if we go to the next slide, what happened was people figured out that if the UST broke its peg, as I alluded to, there'd be an arbitrage opportunity to make some profit. So on May 7th, they started to swap a mass amount of UST into USDC, which is another stable coin. So essentially, right, they're burning it, creating more Luna. There was 85 million was a lot for the market cap of that coin at the time. The selling continued. And the other thing it did was, so it's creating a lot of Luna, which is diluting the value of Luna, which is supposed to be help to maintain that peg. And then at the same time as the market, just someone who maybe is using UST as that dollar stablecoin, I start to see it go to 99 cents, 98 cents, 97 cents. They start selling out of it because ultimately, I don't want to hold this. It's not going to maintain its peg. Luna's being devalued at the same time because it's being increased in supply drastically. So the market's selling that side of it as well. So you had this just intense sell-off. I mean, it really was a sight to see because, our team is chatting about it live, and it's literally went from 95 cents to 40 cents within, a few hours. And it basically lost its peg. Luna lost 99% of its value. A lot of people were hurt. If they had a lot of value in that, there really wasn't a recourse. Eventually exchanges, the liquidity got so low because people just unloaded and got out. They weren't buying, that they had to freeze some transactions. So some people didn't even get a chance to liquidate what they had left. So it was not good. The other kind of interesting factor in all this is at one point, it was before this attack, but it wasn't at the onset part of it, but Luna announced that they bought about, 2 billion in Bitcoin as another thing to help balance their basket, right, and defend the peg of UST. So while all this was going on, Terra sold 1.8 billion in Bitcoin in a few days. So, you just had this intense market pressure all across the board. Not a great situation. And essentially, the fallout, there hasn't been any, concrete regulation or bills passed, but Janet Yellen brought up Terra. It just kind of reignited senators in Congress that, hey, we may need to really regulate the stablecoin market, potentially throwing out a requirement to have a banking license, which is something, we welcome regulation, but I would caution, I think stablecoin issuance is a good thing. To have a banking license would really restrict who could do it. So I think the focus needs to be on just making sure they're not, they have a dollar backing, right, 1-to-1, and they're doing credit checks. Because ultimately, putting the dollars on a blockchain is a good thing, right? These stable coins are getting to people around the world who want US dollars, but maybe don't have access to traditional banks. But this is a way where they can take advantage of it, which ultimately is good for the dollar. So pretty interesting. Definitely one of the more exciting few days in the space since I've been in it. And just a reminder, the questions are out and open, so please feel free to shoot, and we'll keep an eye on that. But with that, I think we're going to the next slide and kicking it over to Ron.
All right, well, thanks, Nick. I think the issue that I think Nick and I are highlighting is that the interesting thing about cryptocurrency, it was built as a way around everything that exists today. It's a way for direct transactions with no middlemen, nobody else gets involved. And of course, the problem with that theory is that then once people start doing that, then they say, okay, and now I want to do other things with it, which are in the legal space or in the financial space, and they weren't designed to match. Crypto was designed to not match. So how do you match something into a sphere that was designed to work around? And that's where we're having all the issues, I think, figuring out how to account for it financially, figuring out how to account for it legally. The answer is it's going to be a real world thing. It's going to end up having to deal with the real world, and we're going to have to figure it all out. Let me give you some ideas about some of the questions that have come up as we've started to do this. Next slide, please. So the very first question, I'm going to talk about a case in a moment. We have to ask ourselves, think about what this is. These things are just numbers on a recording on a chain. They're not really anything if you think about it. I mean, they're not the numbers that they use are not numbers in a JPEG to make a picture of the Mona Lisa. They're not songs. They are literally just a number on a ledger. So is it even something legally that we consider property? A court actually had to deal with this recently, and the question they finally came up with, or the definition, which I think makes some sense. If you want to know if something is property, first it's got to be a thing you can describe. It's got to be something that can be owned, and you have to have somebody who can show that they own it. So with those three things, that's kind of what the legal background of property might be. And if you're trying to think about how that works in the real world, just think about you're just sitting here breathing. The air around you is not property because nobody can point to a specific air and own it if you want to look at it that way. But in bottled gas form, if there's in a bottle, I can say, okay, this is a bottle. I own this bottle. It's mine. I can show you how it's mine. So that's kind of like the idea. Let's go to the next slide. So we're talking about something, being owned. Let's, more typical example, your car. You can certainly point to a car. And we can, certainly it's something that can be owned. And as far as proving who owns it, pretty simple. You pull out the title. The title has on it the VIN number, and it's got your name. And if you look at the car, it's got a VIN number attached to it. And you can prove, if there's a dispute, go to the courthouse or the state house and see who's got the record of being on ownership. Now, the difference for crypto is because it's designed to work around these systems, is anybody with a key to the crypto owns the crypto, right? So in effect, if you're using the car example, anybody with a key to your car owns it. Now, crypto is designed so that the keys are hard to come by. You can't exactly crack them mathematically, not knowing anything or just knowing what's on the blockchain. But people can be pretty careless with these things. And if the keys get published, then theoretically, if they're easy to copy, they're just numbers. Anybody with the key, in effect, would be owning your car, and they would have physical proof by having that number, that key, that they owned your car. That's the kind of weird thing that you have to think about, is how crypto works. Next slide, please. So the example here came up is what happens if it's numbers that are just, not only are they just numbers inside of a computer's imagination, but they're numbers created by system error out of thin air. There's a situation, a token out there called ICX. It's managed by Icon Foundation. Icon Foundation does not own the system, but they run the software and they sort of distribute it to people. The individual people who make up the network run these computers called nodes, and they have a proof of stake model where people stake or attach tokens to that node, and they get benefits for doing so. It's probably enough of a background. There's this one guy, Shin, who is participating on the Icon network. The token involved is called ICX. And for whatever reason, Mr. Shin just likes to move things around. Maybe that's just his way of spending free time, but he moves things from time to time, from place to place. Apparently, Icon releases a system upgrade, in quotes, and it gets the nodes just sort of take it. I guess they didn't do some quality control checking. They put it on. Mr. Shin goes in to move his tokens around, and whoop, 25,000 new ones pop out of thin air. And he apparently, according to the papers, he looked at the stuff and said, "Well, that maybe it's a mistake." Moved it to another node. Boop, another 25,000 tokens. And he said, "Well, this looks like fun." And he starts moving tokens back and forth all around the network. And by the end of the day, apparently created 14 million ICX tokens out of nothing. And I guess anticipating that Icon might not be amused by this, starts trying to move them to other networks so he can, take some of the winnings off the table. Well, surprisingly, Icon was not amused. Icon sent him a note saying, "Okay, we have to take those back. Those don't really exist. That's a system glitch." And he said, "Well, yes, they do." And of course, then Icon takes the step of contacting the other exchanges and saying, "Shin is a thief, lock his accounts." And the other people do this. And now, of course, that leads to legal issues between them and they start battling. Icon says to the court that these aren't property. I mean, they talked about the kind of test we just discussed, but they also said you have to do something. It can't be just created out of thin air. Like in the bottled gas example I just had, you got to put air in the bottle. Somebody's got to do that for it to be, you have to invest something. And the court said, no, for something to be property, it just literally has to be describable, ownable, and somebody has to have a claim. And right now, at least at a motion to dismiss stage, we know what ICX is. It's a token. We know that it can be owned. ICX tokens can be owned. The only question is who owns them, right? So we'll table that for now, but yeah, we're not going to dismiss at that stage. So yeah, even created out of thin air, a token can be property for a legal perspective. Somebody asked, well, what happens if they publish the key and and nobody could prove they had ownership? The answer is if you publish the key, then really everybody can prove a claim. And then, then the battle is, who gets it, or maybe they have to share it, but nonetheless, it's still probably legal property. Next slide. So what kind of property are we talking about? Trying to fit this into the legal framework, right? Trying to, again, take something that's not really designed to work around the law and put it into the law. The closest thing that's out there is really bearer bonds. Why? Because bearer bonds, if you remember, are things that states used to issue to raise money, and they never recorded necessarily who had the bonds. It was all whoever held the bonds got the benefit of the bonds. I think they were used in a movie Die Hard and stuff like that because they were a very compact way of transporting value from place to place. States liked them because they could raise money for roadworks and whatever very cheaply, because if you're not keeping track of anything at all, there's virtually no costs here. They're recording them. You just, whoever shows up, you just make sure that the bond is a real bond and not counterfeit, and then you just pay them. Well, the problem, of course, is if you can move value that easily across state lines and whatnot, they become very valuable to criminals, because it's not like I have to drive an armored car with bullion or anything. I can just walk with a briefcase with millions of dollars in it. So the U.S. eventually got tired of that and made a couple of changes. The first change they did in 1982 was to change the taxation of them, so it no longer became tax effective for states to issue them. So states really lost the excitement of benefit of issuing it. They might as well go through the registration process because they didn't get any benefits otherwise. And then when that wasn't turned out to be not enough, around I think 2000 or 2010, they passed a law that said that brokerages and banks no longer had to redeem them. Well, that takes the value out of it right there, because if you don't get anything for the piece of paper, the piece of paper becomes worthless. I mean, maybe it says it's worth $1 million, and maybe you even gave somebody $1 million for it. But if you can't take them to court to get the $1 million back, end of that market, right? They're still used in Europe, but not so much in the US. So people say, well, can you outlaw cryptocurrency? And I'm like, no, who could ever do such a thing? Well, the thing is to keep in mind, it's already happened. It has happened, at least not for crypto, but for bearer bonds. And nobody thought bearer bonds were going away until they did. So is it possible? Not saying it's likely, but it's the kind of thing you realize that there's ways that people in the US can make them certainly a lot less attractive if they wanted to. Next slide.
Even real quick, Ron, to interject, they outlawed gold in 1933, so not even 100 years ago, something like gold was illegal to hold, which is pretty wild.
Yeah, unfortunately, gold has a real world use that probably won't last as long. It's going to be harder to do crypto. The other thing, of course, if you try to outlaw crypto, is how are you going to enforce that? That's going to be, people can still exchange it, but anyway, just an interesting thing in the back of people's minds that there's all sorts of things that people assume can't happen. Like I assume a stable coin can't fail until one does. And then you start factoring that into your calculus. We need to be aware that crypto has got a lot of odd properties And there's a lot of questions that we take for granted that we might want to just make sure we're not making a bad assumption. But one thing we found out, if it's going to be property, if a court's going to say it's property, even if it's created out of thin air, well, everybody wants to get into the game. Nick pointed this out already in 2014. The IRS said it's property, for tax purposes. Now, think about this, how quick this is. For the IRS, not the fastest moving entity. Bitcoin, the white paper that came out and said, hey, this would be a cool idea. Just an idea still in 2008. 2009 and 10 is just so people are playing around. 4 years later, the IRS is like, hey, we'd like our share. So the IRS can move fast when it turns out, there's money to be made. It's also funds for money laundering and money transfer statutes. So you can't, if it's money laundering when you're doing it with dollars, it's money laundering if you're doing it with crypto. As a matter of fact, breaking news just the other day, Bittrex was fined $24 million plus some extra on top of that for violating sanctions. I think they were helping people in Iran and Crimea trade Bitcoin back and forth on other tokens. And that was illegal under for US dollars to transfer. Can't do it with crypto either. And I think the response was, well, they only had a couple of people, running this bit. How are they supposed to know? Well, the problem is if you're moving lots of millions of dollars around, you have to know these things or else you're going to get held accountable. Commodity. The Commodity Future Trading Commission has made a good argument that it is indeed also a commodity, all cryptocurrency, because as Nick just pointed out, just like commodities, one pork belly is like another pork belly. 155-gallon drum of gasoline of a certain grade is the same as the same 55-gallon drum of gasoline of the same grade. One Bitcoin is the same as another Bitcoin. And there's futures markets out there. So as soon as you have that, Commodity Future Trading Commission says, I think we need to be involved. We can't have these pump and dump type things where you run up a lot of hype and then sell something and then watch the crash where people realize it's all a scam. It also can even be a security under certain circumstances. Now, Bitcoin, probably not. But when you look at it from other perspectives in the Kick Interactive situation, yeah, it can be. Think about a stock. What is a stock for a corporation, right? You give the money to the corporation gives you stock, the corporation goes and does something with the money, and then everybody who's a stockholder shares in the benefits, if there's any, from that endeavor, right? Well, the SEC noticed that some things can be like that with tokens. I mean, in the Kick Interactive was trying to make more money. They thought Kick Messenger wasn't raising enough funds, so they said, hey, let's make an environment where people can get involved and transact things. And, we need to fund a way to pay people to develop it. So we'll just issue this token KIN. People will buy KIN, we'll use the money, build the interactive development. And they hyped it up and they called it, I mean, in hindsight, probably not the smartest move, but they called it initial coin offering instead of initial public offering. And the SEC said, that seems like a security to me because you're raising money to build something and everybody who shares in it, the people who bought KIN. And of course, what the Kick Interactive said, well, yeah, but people can trade this stuff. It's not, you're not stuck with it. And the SEC said, you trade stocks every day too. And so that worked out to not be a great argument. So yes, turns out that some of these tokens can even be securities, and you may have to trade them as if they're unregistered securities if they haven't followed all the proper guidance. So I guess the moral here is that the problem with something that's designed to go around the system is that when you try to stick it into the system, it might light up all sorts of different regulatory frameworks, and you have to comply with all of them if they apply. So that's kind of a problem. Next slide, please. So what does that mean for us? It means as turnaround professionals, if you have cryptocurrency, you have to account for it on a tax return. If you have an accountant, they have to know how to do crypto. If they don't, you need one who does. And if you are an accountant, as many of our TMA people are, this is something you're going to want to keep up with because this is going to be a money-making thing for you because people are going to be looking for how to deal with this stuff. For money laundering, if you have a situation where you have a debtor you're working with and you had lots of millions of dollars showing up in a weird and shady looking transaction, you would need you'd be asking questions. You have to do the same thing if it's crypto, because if it's money laundering with dollars, it's money laundering if you do the same thing with crypto. Same thing with securities. If you have a cryptocurrency you've never seen before, if it's not Bitcoin or something else, you may need to check to make sure that it's not something that is being investigated or limited by the SEC. So you're not yourself trying to liquidate it, now dealing with an unregistered security. Now, again, fortunately, most of our stuff that we're talking about, most likely we'll probably see Bitcoin, Bitcoin Cash, Ether, the main ones, and they're not likely to pose risk. So they weren't issued for that purpose like Kick was or KIN was, but something to keep in mind. Next slide, please. So what about, the stuff, talking about meshing this with everyday stuff? A lot of our people want to talk about buying and selling and lending. So how do you deal with it? Well, like Nick said, it's not really the codes and the systems the legal process wasn't designed for crypto. Crypto's only been around, 14 years, 2022, 2008, even from an idea standpoint. I mean, people played with it in the 70s even, but nobody ever came up with something real until Bitcoin came out, the idea in 2008. So Article 9 of the UCC, that's best guess we have is it's general intangible. Some people want to say it's a financial asset under Article 8. That's got some interesting connotations. That's designed for securities held by brokerages. And then the question, of course, is whether Bitcoin itself is a security. Do you want it to be a security? I mean, it's like there's some possible issues there. If it is an Article 8 situation, then it would be held in trust in some of these Celsius exchanges. But it doesn't quite fit. Like I said, none of this was designed for this. The UCC is really not currently well equipped to handle. For most of our TMA situations, it's probably going to fall under Article 9 as a general intangible. Now, the Uniform Laws Commission, the people who back in the 40s and 50s came up with the UCC, have been trying to keep up with this. They started in 2017 with the Virtual Currency Businesses Act. One state, I thought there were two initially, but when I looked recently, there was only one. Rhode Island is an early adopter. I think Louisiana was considering it, and I'm not sure what happened to their attempt. California is currently considering it. It's a way to try to deal with how this is and mesh it with the UCC, but it hasn't caught on broadly yet. Then there's Wyoming. I really shouldn't have put them under VCBA because Wyoming is doing something. Wyoming has got a set of laws that doesn't really correspond to anybody else's take of the world. It sounds like they're trying to be a new Delaware. All crypto is us. If you deal with any kind of bank or situation where the company has an office in Wyoming, then they say Wyoming law applies. It's of dubious legal enforceability because of minimum contacts and other constitutional issues. But nonetheless, everybody's trying to get around this. The UCC is taking another stab, or the Uniform Law Commission, is taking another stab at this. And I think this might be the one that sticks. Just was announced in August. They've come up with the final draft of it, although they had earlier attempts or beginning working documents that I guess some states have already begun to pass and enact into legislation. Note that the article, they say it's Article 12, but technically it's Article 12, but also changes to Articles 1 and 9. And the most bottom line thing for today, I would say, is that it kind of suggests that the controllable electronic records, CERs, as they refer to, which would include cryptocurrency and NFTs and such, the best way to perfect this is almost certainly to take control. And I don't mean just get a copy of the keys and leave the keys in the other person's hands, but literally to have the stuff in the lender's wallet if you want a security interest. There is a provision, I think, that says you can also do this if you get a third party like a crypto exchange to say that it will do this for you and authenticate that to you. I can't say, it's too new for me to be able to say that for sure, but nonetheless, you want the lender to basically say, I've got this. And why do I say that? Because if you look at Article 12, it sounds like it says, oh, you can file a UCC1. That's no problem, and that'll give you a security interest, except that the UCC1 does not act as notice of the security interest if you're trading the crypto. So if you have a UCC1 filed against a debtor's crypto, and then the debtor spends it and somebody else takes it, sounds like they take it free and clear. If they take it free and clear, well, UCC1 that doesn't act as a notice provision to me isn't a UCC1. I don't care what you call it. It doesn't really have any real effect for me. So I think the safest way is to say you have to literally have it. And the debtor cannot have the currency password any further if you want to lend against it. Next slide, please. Which brings up the next question. Why would you want to lend against cryptocurrency? If you're a bank, you're lending, what you're doing is you're giving the debtor the opportunity to have all the upside, while if there's any downside, you have a security interest in something that declines. Now, I mean, banks do take risks all the time, but maybe, you have some percentage coverage, but that's really hard to do. If you look at what Nick was talking about, a fall of 70% in evaluation is possible. I mean, it can go up tremendously also, yes, but then the debtor gets all of that. If you're the lender and it goes down 70%, what kind of margin are you going to leave as a cushion for that to work? And even if they say it's a stable coin, remember, stable coins can fail, not just the algorithmic ones. They say things are backed by dollars, but I would like to know how many dollars, because the way banks make money, if people who are familiar with banks, is they don't keep the dollars in a vault, they lend it. They charge interest, and that's how they make money on this. They have a reserve requirement of say 3, 4, 5%, depending on what the Fed requires of them. And a Federal Reserve is the only thing that makes sure that they actually do this. If they don't have that, they can't get FDIC coverage and whatnot. Without that kind of requirement that you have a sufficient reserve, the smaller the reserve, the more fragile the system is, and it's subject to runs on it. So before I considered something a stable coin and willing to lend against it on the belief that it's a stable coin, I'd want to make sure that the stable coin has truly got enough reserves to be stable, and that there's some kind of mechanism in place that would prevent it from suddenly not becoming stable at some point in the future. Next slide, please. Now, of course, everybody wants to know about Celsius, the bankruptcy, so we want to talk about that briefly. Are there coins in the Celsius accounts? Are they really property of the bankruptcy estate, the Celsius exchange, or do they belong to the customers? And the question that comes up is, well, what kind of agreement did you have? Is the first thing, right? There's a concept in bankruptcy that if things are held in trust, right, then if they're held in trust, they're not yours, and then theoretically, eventually they have to go back to whoever has the property ownership in them. The thing to know about that is that Celsius had earn accounts, control custody accounts, and withhold accounts. And the custody and withhold are basically a withhold is a custody account in a state that wouldn't allow them to issue, for regulatory reasons, a custody account. So like all the states that begin with N except for New Jersey, I think like North Carolina, whatever, wouldn't allow them. So they have withhold accounts there. But there's where Celsius said, this is not our property. We're going to give you access to things, but we're not going to, it's not ours. At least there you have an argument that you should get it back. But you also remember that, familiar with bankruptcy, the automatic stay doesn't just extend to things, as far as what's part of the estate, but things that the estate currently has control over, possession of. So you may eventually get it back, but they may get to hold on to it until relief from stay is granted. And what that means is maybe you'll get your crypto back, but let's say it's falling really fast and they have it, you can't sell it. That's still a problem for you if you can't liquidate your position, because it's still under the domain of the bankruptcy estate, even if they're going to eventually give it to you back. The other thing to remember is that I talked about in the beginning, cryptocurrency was designed to be separate from the legal system. Effectively, it's all validated by computer, not by law, right? So under the Bitcoin premise, if they have keys, they have ownership, right? So under 541 of the bankruptcy code, technically speaking, they have ownership if they have the keys. That might even override a trust argument. It's hard to say what a court's going to decide, but that's a problem even for those with a very good argument. The people are trying to put Article 8 here because they want to say, oh, but the exchange was acting as a brokerage, and therefore this is all held in trust as a custodial account. In that situation, it's not clear that that's going to work. Also, it's hard to say. I've seen articles trumpeting how the debtors or the customers should have all these rights, but it's not as clear as a lot of these articles like to say. Now, the one thing I can say is pretty clear is that if you lent your crypto to the exchange and trying to get 18, 19, 20% interest rate returns, well, once you lend it, you have lent it. You are a creditor. And in those situations, it sounds like you absolutely are going to be an unsecured creditor, and you'll get back value from the estate, whatever value unsecured creditors get, whether that be in the form of dollars, crypto, not necessarily the same crypto you had before, whatever value that is approved by the bankruptcy plan. So that's, if you lent money chasing yield in a low yield account environment, probably out of luck. Next slide, please. And I think that pretty much covers the kind of legal kind of hairiness that I can get through in a short period of time. I think, Paul, we'll go back to you now.
Thanks, Ron and Nick and Ryan. It's definitely complex and there's a lot of information. So if you're feeling a little overwhelmed, what we're now going to do is a mock scenario. Now, it's not real. I am not a nonprofit CFO, although I'm involved with nonprofits. But so my role will be the nonprofit CFO. Ryan's going to be a turnaround restructuring specialist. Nick is going to be a crypto CPA, and Ron is going to be the crypto lawyer. So let's get started. All right, so Ryan, maybe if you could unmute. Okay, so hi Ryan, my name is Paul Kueber and I run a nonprofit that helps solve childhood hunger. Recently, I've been having trouble paying my bills, especially this loan for my building. I'm not sure I can hit payroll this month. I think I'm in need of some help. Can you help me?
Sure, Paul, I can help you as a turnaround specialist. The first thing I'll need to understand is your balance sheet, your general ledger, your assets, your loans. Can you shoot me over all that information? I'll dive through that and get back to you once I have looked it over.
Okay, Ryan, let me get that over to you. Thanks.
Paul, I've looked over your financial data. I definitely know that I can help you, but there's one important thing that I really want to understand, and that's the asset streams, revenue streams, and more specifically, the grants and donations. I also think that I can help you restructure the loan, but I'll also need to know a little bit more about this Coinbase account that I saw in the list of all of your accounts.
Well, Ryan, in the Coinbase account is a few digital assets that we've received over the years. We have Bitcoin, Ethereum, and AMP from a bequest. I really was thinking of holding these for the long term to support our future.
So Paul, I deal a lot with 13-week cash flows and balancing, but I know a CPA that specializes in this, and I think it would be best for us to give him a call. So,
Okay, Ryan, maybe I'll do it with you and help with any questions.
excellent. Nick, I'm on the line with Paul here, and we have a situation that deals heavily with crypto. Do you think you can help us with it?
Yeah, absolutely. So let's pull it up. I think so. Coinbase account looks like Bitcoin, ETH, and AMP. So that's fine. The Bitcoin and ETH really are easy. If you want to hold it, great. If we need to liquidate it, they're pretty large markets, so that shouldn't be an issue. But the one thing I need to double check is I'm fairly certain that AMP is currently being sued by the SEC. There's been a number of actions from them over the last few years. I'm fairly certain AMP was on a list. So let me pull that up real quick because yeah, so confirming AMP is under investigation. So since it is, I'm not sure we can just sell it. For one, some exchanges have already delisted it. So, Coinbase doesn't appear to be one of them yet, but that could happen without much notice. And then conversely, I just want to make sure we're okay if we were to sell it. So I think I need to get an attorney's input on that one. Just before I do, so we have the full picture, Paul, do you have any other crypto exchange accounts or wallets outside of this Coinbase one?
Let me think. I think I have some sort of paper wallet around here that we received Bitcoin from a donor, and it might be in my desk somewhere. I can't seem to find it.
Okay. Well, paper wallets are sometimes the most secure because they've never touched the internet. They can be very unsecure because if you can't find it, Paul, we're kind of out of luck. Those keys are really your only way to get those funds. So not great. I would recommend if you recorded it on the balance sheet when you received it, that we go ahead and write that off. Because again, there's no other recourse if you don't have that piece of paper. Maybe turn the office over one more time. But if you don't have it, I think we should write it off.
Yeah, I don't think I have it.
Okay. All right. So we'll write that off. Did you pay any vendors or employees with crypto out of the Coinbase account?
I was starting to use that. So I did use crypto to pay a vendor. It was supposed to be for a social media advertising campaign. And after I sent payment, they never launched the campaign on the internet and they just went dark.
Okay. All right. Well, so since the payment went out, make sure your accounting records reflect that. It's still an expense, even though you're not getting the service for it necessarily. And we want the Bitcoin that was sent, unless we can track them down, we're not going to be able to reverse that. But that being said, we can add that to the list for Ron to consider. He'll likely want to just know more about how much that was valued at and then kind of make a decision if you want to go kind of the civil route. So give me a few minutes. I'm going to reach out to Ron and let's get you guys connected and move ahead. So I'll talk to you soon, Paul.
Thanks.
So, hey, Ron, I've got something interesting I need your help with, please. Here's all the information we've compiled so far. Kind of the key points I need your help with is one of these tokens is currently being sued by the SEC. So just want to make sure if there's any issues with us selling it in that process before they determine anything. It is being sued as an unregistered security, if that's helpful to know. And then there's this issue of non-payment, or they didn't receive services for something they paid for. They paid the vendor with crypto, but never got the services. So if you could kind of give some insight there, that would be great.
Okay, and just confirming, they're not yet filed for bankruptcy. They're just in a workout phase, trying to reorganize still.
Yeah, that's correct.
All right. Okay. Well, as far as the token is concerned, I certainly can get consult with an SEC guy on our team, and we'll make sure that we find out what the disposal rules are. Make sure we don't run afoul of any of that. As far as the vendor, we should probably get the legal name. Make sure we understand who they are. I mean, just because they accepted crypto doesn't mean they're free and clear in the real world. We can see if they've been sued by anybody else, and maybe there's other issues going on. We can jump on board with that. If it turns out that the amount of dollars is minimal, it may not be worth it. But I'll let you let me know if it's enough to be concerned about. But let's at least check for litigation quickly. Also, I would have the guy. You said Paul was his name. I would have him check, make sure we understand where that any of these crypto came from, especially the things that he's not familiar with. Make sure that they're not something involved with some kind of and we don't want to have something showing up or somebody donates something and it turns out that it came from a location that we don't want to be involved with. There might be money laundering issues or other concerns, and we also want to make sure that he's the only one with the access to the keys on these things, and that they're not nobody else, because as you I probably already told him, not your keys, not your crypto. We want to make sure he doesn't he doesn't have an issue with somebody else kind of running off with the money, so to speak.
Okay. Yeah, no, understood. Good points. I think I'm still going to make sure he kind of gives us a history of where things came from. The good news is, since it's coming, he's got a Coinbase account where he's receiving it.
Okay.
Coinbase definitely has some internal practices in place to make sure, if they do, blacklist certain addresses, to your point, right, that may be associated with laundering or other criminal activities. So Coinbase, for the most part, won't accept those, but still noted, and we'll make sure he goes through that. And then I'll give him the update on the other stuff, Ron. So thank you.
Sounds good.
Yep. Hey, Ryan. So quick update. Ron is going to consult an SEC lawyer on that AMP and reach out. In the meantime, and I did tell Paul this, but just remind him to kick over the legal name of the social media company they paid but didn't get services from. Definitely let us know the value of the crypto at the time sent and any invoice or related support for that. That'll help kind of determine if it's worth it to pursue the legal action or not. And then lastly for Paul, and I didn't mention this to him, but can you have him just does he have a good sense of where the crypto they do have it's come from? Is it donors they have relationships with? Was there any anonymous? Because we just may want to double check and do a little more digging on that front. And I think that will really cover the bulk of it. So if he can get those things over, Ron should be able to help. And then I'm here if you got any other questions along the way.
Excellent. Thank you. Yeah, I'll reach out to him and let him know. Hey, Paul, I spoke with Nick and we got a plan in play. The first thing we'll want to do is value the crypto and follow up with the securities lawyer. But one thing I do want you to be conscious of is when we value the crypto, it may not be at the same value that you thought it would be at. It may be lower. So one thing you may want to do for the future is put together a plan in play for buying and selling crypto. Make sure you have a policy in your system and all your employees are aware of it so that this issue doesn't happen again. I know that we'll be able to help you with this stuff. And we'll be able to restructure your loan, but you may want to make sure that you thought all this stuff through. There's a couple other items that Nick wants me to go through with you. You're going to want to shoot over some information about the vendor and the marketing advertisement services that they were supposed to provide for you. With that, I think I can help you get the loan restructured once all this stuff gets wrapped up.
Okay, thanks, Ryan. I'll get that over to you right away. I really appreciate the help. I just didn't know crypto was so volatile and had so many stipulations. So I appreciate the insight of you and your team and all the behind the scenes work.
Yep, not a problem. Happy to help.
Okay, so that's the end of the mock scenario. So we have a couple questions. I think the first one, maybe there's a couple here, Ron, that maybe you can take. What if a debtor says there's no crypto and you don't know if you believe that, i.e. you expect more assets than there are and you want to know if they're hidden as crypto?
Well, I think, first we want to make sure there's enough to be worrisome. I mean, we don't want to chase down every stray bit, but if you think there should be significant assets and they're just not there, you can always check accounting records. This is where somebody, where Nick or somebody with an accounting background. Forensic accounting is the same for crypto in some respects as it is for almost anything else. Money generally doesn't appear, or services don't appear out of thin air. So when stuff just appears on somebody's books, you can take a look and see what led to that. If there's outflows of dollars to buy crypto, then that's fine, because oftentimes people just don't just give it to you. But if it turns out that somebody just gave them crypto, and that's it, it's very difficult to uncover that. But for most other scenarios, you can probably take a look. If you need to, you can also go back and subpoena bank and credit card records, because that's one way to find out where the money went to. Because if they're buying crypto, they usually have to give somebody something to get it. But again, I think it comes down to how much is at stake. You don't want to be, just because it's crypto doesn't mean it's bad. Or if it's a tiny amount, we don't check for, oh, this guy's missing a $20 bill. You got to be in perspective.
Okay.
I guess go ahead.
No, I was going to grab the next one. What if the debtor admits it has crypto?
Well, the first thing you want to make sure, if it's in a bankruptcy scenario, that you get it secured. I mean, you want to know who's got the keys. That's the key thing. If the debtor has got the keys, but somebody else has the keys, then it could be transferred away, and that's not good. The other thing, and so one way, if you're the trustee, if you're in a Chapter 7 situation, you probably want to secure it by having it transferred to a wallet that you control. You also probably want to get an order of liquidation sooner rather than later, especially on something volatile, so you can lock in values. Now, I mean, there's always going to be people second guessing, oh, you should have held that, you would have gotten more money for the estate. But I mean, with the scenarios we have today of something really volatile, just treat it like any other really volatile asset. And most of the times I understand that for a really volatile asset, the way you do is reduce it to cash and then deal with it at your leisure.
Okay. What if the debtor won't give up the keys?
Well, that's the fun part, because, contempt of court is always great. I think most bankruptcy judges will say, a debtor can, if they really, really, really won't do it after court orders, they can take a toothbrush with them, and they can sit and consider the error of their ways in not giving up the keys. That's the way contempt of court works. It's a compulsive sanction, where the law likes to say, and the debtor has the keys to his prison at his own leisure. If he just won't give it up, then maybe he needs some time to think about that, just like a child might in a timeout scenario. And then once you get the keys, quickly move them somewhere. The fact that a debtor turns over the keys to you, if they just give you the keys, that's great. But until it's moved, they still have the keys. Remember, these things are also duplicated. So if you don't move it, they still have it, and bad things can still happen.
Okay.
Yeah, those are great points. And one other caveat, let's say that guy gets his time out to the extent the court can give it to him, and he still doesn't relinquish it. He says he lost it. One of the beauties is that wallet that they know it's in will get flagged, right? And if down the road he thinks he's off the radar, he'll go move it. There are law enforcement watching that. And we've already seen to date with, Silk Road bust and the FBI agents involved. You can look that up, or other situations where big hacks in Bitcoin or crypto got caught down the road, because everything is transparent, as Ryan alluded to early in the presentation, right? So they flag the wallet address, they watch it move, and as soon as it goes to an off ramp to get cashed out for a bank or paid for things, they can start to find them. And in one instance, they caught people who were trying to just buy small gift cards to liquidate their stealing. And so really is not great for criminals from that perspective.
Right. And the key is to make sure that the punishment fits the crime. We don't want to do all this stuff if we're talking about $100 or $1,000 worth of crypto. I mean, if there's serious money, there's serious consequences.
Okay. Okay, that was all the questions that I saw. So I think that's it. So I want to thank all of our panelists. I think Ryan, Ron, and Nick, you guys did a great job, and appreciate your insights and all the technical expertise you were able to provide. And with that, I think our webinar is over. Thank you, everyone.
Thank
Thanks
you
all.
for attending.
Thank you, Paul.